So, you just calculated 225. Did you know this answer? Yeah, we did it last class on the single step. I mean, it's not like you're getting something new, right? You're getting the same answer. It's just you're getting it in a different way. And what's nicer about this is, this is kind of telling you, okay, I can figure out my gross profit. This is telling me how much I take home from every dollar of sales I make. Then I have my salaries, expenses. I get a sense that this is the income I can expect from my main primary business. Okay? If a company has two lines of business, they would all be operating. It's not that it's, core means you have to be 85% of the business or more, but this is kind of what we do. This is our bread and butter. On the other hand, this is stuff that's peripheral to our activities. Yes, we do lend money, and as a consequence, we might make some interest. Or yes, we do borrow money, but we're not in the business of borrowing money. We're in the business of operating, and then we just borrow money as a side. These expenses are not trivial. They're important. I mean, if I have to pay interest, I need to know that. I need to have enough cash to do that, but it's not the same sort of profit driver as some of these other expenses. Okay, and then, so this is the easy case. So up till now, you probably felt like, yeah, everything I've seen, I could have done this. And now we're going to start introducing some more complicated issues, which you haven't seen before. Okay, so in this nice and simple financial statement, we have basically three sections. We have the operating section, we have the non-operating section, and then we have the tax part. And in real financial statements, they're messier, and there are other things that could happen in the company. So what could happen? Well, the first thing is you could have a discontinued operation, and if so, you want to present that after you're continuing. So even though this is non-operating, it is continuing. It's sort of going to happen year after year. It's just not necessarily going to be part of your core business. Down here, you want to identify things that are much more irregular or unusual sometimes. So discontinued operations would be a situation where a company has a couple of different business segments, okay, and we'll define what that means in a minute. And so let's say a company makes hardware and software products, and it decides to spin off or divest its software business. Now, when you're thinking about this part of the financial statements, and you're thinking about projecting, so you want to be able to figure out what next year this company is going to be able to deliver. If it sells off half of its company, would its performance in this year be indicative of the future? Probably not. Even if it did well in both segments, if you're going to get rid of one of those segments, you can't really expect that to happen again. So what we do is we say, okay, well, we should take out of operating activities anything that we're discontinuing, okay, and stick it down here so it's clearly identified as this stuff is gone, okay? Yes, we did make money or lose money on it this year, but in the future, you won't expect that to happen. Also, we have sometimes crazy things that happen to us. Extraordinary items. Now, extraordinary sounds like maybe good. It's not good. Usually they're bad. The accounting definition of extraordinary is unusual and infrequent. Now, that said, that's all you get. So as an auditor, you have to define what does unusual mean. So if you had to put like a probability on what does it mean for something to be unusual? Does it happen with 5% chance? Does it happen with 12% chance? 0.01%? Like, what does unusual mean? What do you mean the small? Like 1? Unusual. It doesn't mean never. It's unusual, but Okay, but what if you live on the San Andreas Fault? Wouldn't that not be that unusual? Or you live in a country where earthquakes are pretty prevalent, and so yeah, I would say an earthquake in Newark might be pretty surprising, although didn't one happen last year? Unusual is in the eye of the beholder. It's not really well defined. There's no explicit probability, and also for a lot of these things, we don't even know the probabilities, right? I don't know what the probability of an earthquake happening in this area is. So if one happened, how would I determine whether that was unusual? So that's the first. And the second thing is, unusual and infrequent. So it's odd, and it doesn't happen very often. So you need both of those things to be met, okay? That would qualify as an extraordinary item. And only after that point do we come up with a net income number. But there are two important things to know. If you have your income tax up here, your income tax is based on all this stuff above it, right? The way we computed income tax, or the way you typically do, is you take your income, you multiply it by your tax rate, and that's your income tax. Well, what happens if you stick stuff after that? Then you would have forgotten, in some sense, to tax those things, or forgotten the tax benefits of those things. So we have to treat them a little bit differently. We treat them net of tax, which is we take the amount less the associated tax expense because we've already done the taxes. Okay, not literally like filled out the tax forms, but sort of we've computed taxes based on everything up until this point. So hereafter, anything we add has to be computed after tax. Okay, and I'll explain how that works. Then we get our final net income, and then we calculate earnings per share. You will see sometimes two types of earnings per share, basic and diluted. Okay, basic always is more than diluted. Basic uses a number like, say, the one I gave you here. Okay, and then diluted, you'll figure or learn how to compute diluted earnings per share in Intermediate 2. But the idea behind diluted earnings per share is that there are some things that don't really qualify as shares yet, but hypothetically, if everybody exercised them, they would be shares. So here's an example. A manager has a lot of stock options that aren't vested, so they're not allowed to exercise their options yet. But potentially, if the stock price goes up and if they were to exercise, then those additional shares would be outstanding. Those could be included in the denominator of fully diluted. So fully diluted is kind of like worst case scenario. Everyone exercises all of the shares that are potentially even out there, and this is what we would deliver for all of our future shareholders. Okay? So let's look at Apple just so you get a sense of a real, this is a real financial statement. And it doesn't look that different from this one, okay? They have pretty simple operations. They're pretty successful, so they don't have to discontinue anything, okay? They don't have any extraordinary stuff going on. So what do they have? They have sales, cost of sales, gross profit, they should call it, not gross margin, because margin would be divided by sales, okay? Operating expenses, they've got the ones you would expect, research and development, and then all of their salaries, depreciation, rent, all that going in SG&A, okay? And they sum that up first, and then 43 minus 10 is the 33. Operating income is equivalent to your operating income here. Other income and expenses, they don't even bother listing what kinds they are because why don't they bother like telling you all the details? There may be a lot of them. That's one thing. Why else? If I'm like looking at Apple and I'm trying to think about, do I invest in this company? Yeah. Okay, so it could be we don't want other people to know what the source of our other revenues and expenses are. Look at the numbers. Like if I'm investing in a company and this is the magnitude of their operating income and this is the other, it's like not even it's a scale issue. Like nobody cares. It's not enough to make a difference. So while it's true they have it, and of course they have to report it, it's not the level of detail that an analyst or an investor needs to know about that sort of thing isn't the same as the bread and butter. Like why did they give us, okay, this is in their financial statement, the detailed breakdown of revenue. Well, they gave you detailed information about revenue. This wasn't on their income statement, but this was additional supplementary information because that's useful in predicting future revenues. However, knowing the breakdown of the 415 versus the 108,000, you just sort of say, who really, why bother? Okay, so, an analyst might not even forecast this component and just say that's noise. Okay, then you have your income before income taxes. What else? Sometimes what do people call this line item other than operating income? What's another word that people use for that? It's one of those EB things. So this would be EBIT. Okay, then we're going to add interest and stuff, and now we're at EBT. Okay, we have our provision for taxes, and then income, just like this. So the real world looks just like, we've created. You're ready to go, except Apple just happens to be a fairly simple company. What happens when you look at companies that are less so? So earnings per share, they have basic and diluted. They tell you how many shares are outstanding. So, you could have figured, once they tell you earnings per share, you could have calculated what number they used as the denominator, but they also just tell you. Okay, so it's kind of like in my here, I told you this is how many shares are outstanding. They tell you here, this is how many shares are outstanding. So, looks like what stuff we're comfortable with. But here comes the irregular stuff. Okay, so let's say you've got multiple operations within a firm, and you can separately distinguish the two components within your firm. So they're not completely integrated. It's not like I'm using this machine to create my primary, did I just shut this off? No. To create my primary product, and then I sell one of the machines. It's that I use all these machines to create product one in a totally separate factory. I use all these other machines to create product two. The two don't really mix very much, and I can completely dispose of product two without interfering with the operations of product one. Okay, so if that's the case, so if the operations and the cash flows of these two separate items can be clearly distinguished, both operationally and for reporting purposes, then if you want to sell one of those two components, it could be considered a discontinued operation. If you just want to sell a single asset, it shows up here. Remember, we have gain on sale here, because that's not an irregular item. You sell assets all the time. It's not your main line of business, but as your assets wear out, you get rid of them. Sometimes you have a gain, sometimes you don't. Sometimes you have a loss, whatever. But when you really dispose of an entire operating unit, that doesn't happen very often. Okay, so that's sufficiently important that you want to separate it out. Also, because the stuff, the gain here had produced some of this operating profit, it makes sense to kind of match them together, whereas any of the operating or any of the income from the operations that you're going to discontinue should be taken out of this, so that when I'm predicting the future, I'm not including stuff that doesn't exist anymore. So what I do is I take all of so I have these two separate segments. I figure out how much income has the segment I'm getting rid of produced this year, and then what happens when I sell off all the assets. Do I have a gain or a loss? And what about just the operations? And all of those things together are going to be put in discontinued operations in a separate line item. And the benefit is twofold. One is this stuff is unaffected by this discontinued item, and so if I want to use it as a basis for forecasting, it makes some sense. And also, I have a better sense down here of what that future stuff, whether it was a good idea to get rid of it or not. Okay, so I can kind of clarify those two things. I have to report it net of tax, and if you're planning on selling it but you haven't quite executed it yet, you still would like to hold it aside and put it down here, and you would put all of the assets as held for sale, and you would put all of the discontinued operations, just the income from the operations, even if you haven't yet executed the sale and experienced the gain or loss, you want to put them down here as soon as possible to tell people, hey, we're planning on selling it even if we haven't fully finished the sale yet. Okay. Yeah. Well, no. So it's not necessarily the case that the assets will have a value of 0. Okay. So let's say you have these two segments. Okay. let's see if, I'm not sure this is going to, there we go. Okay. So let's say you have segment 1 and segment 2. And segment 1 earns, $50 million, and segment 2 earns $20 million. Okay? Now, I decide I want to spin off segment 2. I don't want it to be part of my company. It's not necessarily losing money. It actually earned $20 million there. But if I'm trying to tell my investors, hey, what can you expect sort of down the road, that $20 million shouldn't be included. Now, why would I be spinning it off? Maybe I'm going to make more from it by selling it than I was making by myself, right? It's not always. Okay, on the other hand, I could be losing money in this segment, okay? If I'm losing money, I would say maybe have a $20 million loss. That, too, shouldn't be draining down my financial statement. But it's only the income that's going to show up here prior to the sale. Once I sell it, then not only the income from the current period, but also all, like, if I have a list of assets, I sell those. If I get a gain or a loss on those, that also will show up down here. Okay? So here, it'll be much clearer if we use an example, and then you can see how it works. Okay. So here's just a company. So you can see, Apple looks all nice and clean. You don't have to be able to read this. It's just the idea is you have all the sales, cost of goods sold, operating expenses, etc. Everything looks the same until we get down here, and then they have some more interesting other things, and they give you a little bit more detail about their other things because they have net interest expense, which is just interest expense minus interest revenue. They have income from a joint venture, so that was here in the other that was different. Okay, they have some gains and losses on foreign exchange, other, and we're still at continuing operations, okay, taxes, earnings from continuing operations, and now we've got this weird thing that we didn't have for Apple or for this company, which is earnings from discontinued operations net of taxes. Now, here's a number. Why isn't there any number here and here? I discontinued it, so we're done. We're discontinued, right? Once you discontinue it, we're not going to discontinue it anymore. Okay? So you're not necessarily going to see by 2007 this line may be gone from this company because they no longer have to show it to you. Okay? But the idea is they're showing it after taxes, and they're telling you what the total amount of, and that is both positive and negative. Okay? So you can see here they actually made money on the disposal. Okay, this is a positive number. 3175 plus 60 is what's giving you. But they're saying, hey, we don't have any of this stuff anymore, so don't expect it next year. Okay, so let's talk about it in the context of an example, and then you'll be able to sort of see better how this works. Okay, so let's say we have a company that has multiple components, and this company, CMC, completes the sale of its semiconductor business, and it sells all of the assets. So it's got land, building, a bunch of equipment, anything, whether it's patents or property, anything, whether it's listed or not, it sells the entire segment for $10 million to some buyer. That's what the buyer's willing to pay. That's what we're willing to sell it for. Okay, question. Okay, this idea that this business segment qualifies as a separate component, I'm going to lose that, is important because if it didn't, if it was just sort of a subset of the existing component, we would just have to treat it like a normal sale. But because it can be identified as a separate component, we can consider it a discontinued operation. Now, they tell us that the book value of the segment is $8 million. What does that mean? What does it mean, the book value of the segment? Yeah. Okay, well, what do you mean? It's what we. So the $8 million. What is that telling me? That's the historical cost of the assets minus depreciation, but also minus any of the liability. So the net. So if this segment is operating by itself and it bought a bunch of assets and it took out a bunch of loans, the person buying it has to buy the whole thing, the loans, the good and the bad, okay? So it's buying the net book value, which is all the assets minus all the liabilities of this segment. Okay, so all of the assets, all of the liabilities. Why is this other company willing to pay $10 million when I'm telling you that we have all the assets minus all the liabilities recorded at 8? Yeah. Okay, so one reason is the business might actually be profitable. Okay, what else? Yeah. Okay, so I have this recorded at whatever I paid for it. What if I happen to have bought a machine that is very hard to find, and this other company actually needs that machine in their operations? Even though it's like old and depreciated from my perspective, it might have a higher market value. And accounting says you can't write up the market value until you sell it, so I'm not really trying to, the book value is not telling me what the market value is. The market value is $10 million. That's what someone is willing to pay for. Okay? Now, the other, so of course, if this company, some other company thinks it can do more with the firm than I'm doing with it, it might be willing to pay more for it than the book value, even if the book value is pretty close to market value, right? So it's there, the market value is estimating the present value of all the future cash flows, including whatever they can, get from the current assets. The book value is only telling you here's what I paid minus here's, whatever depreciation I've taken. In some cases, it might not be historical cost. For the most part, that's what this is telling you. Okay, so you said I'm getting a sort of $2 million gain here. Why? Well, what's going to happen is See, I'm putting the brackets, but realistically, everyone would know income taxes if you have a positive income and it's negative. But I like to bracket everything just to be safe. Okay. So what do I have here? Okay. Now I need just one number. And they gave me a lot of numbers related to this discontinued operation. So how am I going to take all that information and put it into one number? Okay. Well, I have the $2 million gain on sale. Right? Remember, it was $10 million that I got minus $8 million for book value. Okay, plus I had the, what was it, $3.6 million, sorry, this doesn't look very much like a zero. 200. Okay, the $3.6 million loss from operating the segment in 2011. Okay. So I was at 1.6. Is this before or after taxes? It's all before taxes. Okay, so 1.6 before taxes. What would the tax be on this? $480. Is it plus taxes or minus taxes? So normally we have to pay taxes on stuff. But if we have a loss, they give us a tax break. So they actually, it's not that they're going to give us money back, but instead of us having to pay all those taxes on the income in the other segment, we're going to actually be able to reduce our taxes by $480,000. Okay, so this is actually a plus tax benefit, okay, because we had a loss. Now, had this been, $4 million gain, then we would have to pay additional taxes on the disposal. But instead, we're going to actually get a tax cut here. Okay, so what do we have? Boom, boom. Okay. This is my net of tax income or loss, in this case, from discontinued operations. Okay, so 1, 1, 2, 0. Now, what you would normally see from a company is they would not have the brackets. They would just have written loss, and so then it's obvious it's a minus. Okay, but if you write income, then you have to make it clear that this is actually a loss. Okay, and then what's the company's net income? Okay, so does everyone understand why we need to put this discontinued stuff at the end? Why we don't want to have this $3.6 million attached or in the same bucket as the $5.8 million? Both of those are, we ran the business this year, and both of those are income from running our business. But if we put the 5.8 and the 3.6 together, okay, and we only present income of 2.2 million, people will think our company, the remainder of it, is pretty cruddy, right? They're going to be like, okay, well, you've got this business, and all you're really going to be able to generate is $2.2 million per year. When in fact we have sloughed off the bad arm, we've cut it off, and we actually have a much more profitable business when you don't take it into consideration. Now, that said, if this thing were positive, if we were still making money from this segment, then what would you really need to see in order to think this was a good sale? If this segment was very profitable, Would we want to sell it under most circumstances? No. Why would we want? What would be the conditions that we would be willing to sell it? Well, this number better be pretty big, right? We're going to make some money on it. Okay? There's nothing wrong with selling something profitable, but you don't want to sell something profitable unless you're making a lot of money for it. So it's a good idea. Like, let's say you're cash poor and you have a profitable segment, and the other segment needs some infusion of cash. Well, you might be able to find a buyer who's willing to, kind of front you the cash for this long future stream of profits, and then you can focus on one business. Other times you'll see companies dividing themselves just because they feel like their focus is getting out of control. So they merge, and then they realize, we weren't able to sort of do a good job synergizing the companies or creating a good corporate culture across these two, and so we're going to divest. So some very common examples like Time Warner AOL, disaster merger, Daimler Chrysler, another disaster merger, right? They thought they could kind of Mercedes, you always thought, well, does Mercedes really want to be associated with Chrysler? And the answer, no, they don't. So those are examples of times when you'll see them merge, and then you'll see them just undo it, okay? And why are they undoing it? Not necessarily because each segment in itself is unprofitable, but together they don't actually enhance each other, okay? And somebody else can do it better. Okay, so that's, anyone have any questions on how this part's done? Because extraordinary items, the process is exactly the same. Usually with an extraordinary item, you don't have both a sale and a loss. You'll just experience one loss, and you'll just take the hit, and it'll be net of tax. But it's always important that you remember, I've already looked at the tax bill based on everything prior, so whenever I present anything after taxes, it needs to be net of tax. Okay, that's going to come up all the time. That's the kind of question I really like to ask you. All right, yeah. Where did I get the 480? Okay, so remember our tax rate was 30%. Okay, so when I took 30% on this part, but I also need to take the 30% on this part. Okay? Other questions? I want to hear them. Yeah. So if you're abandoning a segment, then it's going to be down here, okay? And you're just not going to make, obviously you're not going to have a gain on disposal of the assets. You're going to have a loss on disposal of the assets because you need to get rid of the assets off your book. And then since you're not getting any cash in, you're just going to, whatever the book value of the assets is going to be your loss, plus any operating loss. Exactly. Right. If abandoning it is the right option. So when would abandonment be the right option if you can't find a buyer and your year-to-year losses are actually more than just, calling it quits? So even though $8 million seems like a lot, if you would lose $3.6 million every year for the next 10 years, it seems like, well, maybe I ought to get rid of this thing, even if I can't find a buyer. Okay? So, but if you just think about abandoning like a single asset, then it follows the same rules as a single asset that you were selling. Okay, yes, you would experience a loss, but it wouldn't be separated out below the tax line. This is held exclusively for discontinued operations when you can identify a segment that is entirely separate from cash flows and earnings and performance. So it's not only reporting-wise, but also operationally. Okay, other questions? All right, so let's go to another one. Now this one you should now be able to do, okay? We've got a company. They have common stock, 4 million shares outstanding. They just happen to have a $5 par value. They don't issue any additional stock. during 2010, and here are the things that happen. They have income from continuing operations before taxes, discontinued operations before taxes, it's a loss, okay? They declare dividends, they have a 35% tax rate. What is their earnings per share? So how are you going to go about doing this? Well, you want to do exactly like this. You want to first do this, taxes, earnings from continuing operations, net income, and then divide by common shares outstanding. So let me give you 5 minutes to play around with that. in their part of the country, severe damage from hailstorms is extremely rare. Okay, are hailstorms kind of like normal things? Do they happen often? Are they usual? No. And in this particular place, they're saying it's incredibly infrequent. Would you think that if they had significant damage, you could put that as an extraordinary loss? Yes. Would it make sense to do so? Yes, because we don't want, when we're trying to figure out how well is this company going to do next year, we're not going to expect another amount of hail damage. Okay, we're going to try and figure out what they're worth without the hail damage. Now, if the hail was permanent damage, then that would be different. But this is just to the current crop. On the other hand, let's say a citrus grower's Florida crop is damaged by frost. What do you think? I mean, it doesn't get cold. I mean, yeah, the whole reason we grow citrus in Florida is so that it doesn't get affected by frost. But doesn't it pretty much frost over like at least once every 3 years? I mean, or they're constantly talking about problems with frost. So you kind of got to say, I don't know. Is that irregular? Is that unusual? Is that extraordinary? What about if you go to Napa and you see these giant fans in the vineyards, right? And the reason for the fans is to blow the air so that the frost doesn't settle on the grapes. Let's say they had a lot of crop damage due to frost. Would you say that's extraordinary? Napa Valley doesn't get that cold there. Is that extraordinary? What would be evidence that it's not? If you have a fan, you know it's going to happen. Like, you're pretty much saying, yeah, it happens, right? And it's not that out of the question. It's worth investing in fans. So I think you got to kind of look at the particular company. There's no one right answer. So this is going to stress you all out. I'm not going to tell you the answer here. I don't know the answer. It's very contingent on the company, the auditor, the agreement between them, and what the event is. Yeah. Not necessarily. Not necessarily. I mean, they might try, but their auditor might push back and say, nope, this doesn't qualify in our judgment as extraordinary. And at some point, they might discuss it sufficiently much, ask the SEC for clarification, and the SEC will make a call. And they may say, no, it's not extraordinary. Or if you do classify it as extraordinary and the SEC decides, no, we don't think so, you're going to have to go back and restate. So you want to be pretty careful about getting that classification right in the first place. And it's not, I mean, it's a judgment call. It's not a certainty. Okay, another example would be what's unusual and infrequent to one company may not at all be unusual to another. So let's say we're talking about a company like Morgan Stanley buying and selling shares. Happens all the time. Obviously, we're not going to, that's their business. That's not unusual or infrequent. But if you have a company where they have never owned any other stock, they happen to own this one unit, okay, they happen to sell it all off in 1 year and earn some sort of supernormal profit or loss, they would want to identify that as extraordinary because it was sufficiently unusual and frequent. They have no plans of having an ownership like that in the future, nor do they have any other existing ownerships in their firm. So it's really firm specific and event specific. There's no bright line test which says, well, if it's at least 30% likely and here are the things that qualify as extraordinary, because oddly enough, following September 11, many companies said, well, obviously the events of September 11 qualify as extraordinary, and the SEC said no. So, who defines extraordinary is very, very, it's a very unusual and difficult to apply standard. Okay, there are a couple of other things that are going to come below this line. And one is, if you change your accounting principle, you need to tell everybody, hey, we've changed. Why do you need to tell people you've changed? What is the rule that we're violating? Consistency. We want to be consistent and comparable from year to year. If we're not, we need to tell people. More importantly, the reason we're changing is probably because it affects our income statement or our balance sheet in some way. So what we need to do is we need to record the effect on all of the income statement that we present up until this point. So remember we had 2005, 2006, and 2007. We need to present them all fairly, okay, as if we had used the same rules. and we need to take the impact in the current year of any changes to the rules and separate that out as sort of a one-time thing. However, if we just change our estimates, we wouldn't do that. Changes in estimates, like, oh, our depreciation expense changes, you leave it alone and you just kind of move forward. We assume there are always changes in estimates. If we make a flat-out mistake, or fraud is detected, or we somehow misapply GAAP, okay, then we have to go back and restate our financial statement. So it's not just a matter of settling up and saying, oh, we overstated last year by this much and now we're just going to shove a loss here. Then you have to actually go back and do the process of restatement. Okay, so these are some other irregular items. Change in accounting principle is the one that you would see here after tax. Okay, the other ones would be more, in change in estimate, no big deal. An error requires a significant restatement of all the financials. Okay, so here's like just a table for you to kind of conveniently have what you have to do if you have these irregular items. You have to correct, you have to just move on and do the best from here on out, or you have to create comparable financial statements from year to year and have the one-time adjustment to retained earnings. Okay, so if